video presentation is not for sale and was paid for with your tax dollars. It's intended to be a free service to residents of the state of Mississippi. Hi, I'm Mike Vanderlip with the Mississippi Small Business Development Centers, and today I want to talk a little bit about financial ratios. Most people are afraid to use financial ratios because they find them a little bit too complex and, quite frankly, a little too mathy. What I want to do over the next hour or so is break the financial ratios down, talk about each one of them, talk about how they're used, where they're used, and when they're used appropriately, so that you can see the true value associated with using financial ratios to help you run and manage your business. What are financial ratios? Very simply, it's taking financial information from the outcomes, that is, from the operation of your business, and using those in novel and different ways, multiplying some together, subtracting them, and so forth. But once we take the raw financial data, run it through the financial ratios, we then have outcomes that we can use to compare your business against other businesses and your business against operations from previous years. So my primary motivation is to get you to at least take a look at financial ratios, and more importantly, to take a look at how they might be helpful to you in operating your business and making day-to-day management decisions. So as we get started, ratio analysis. We can use ratio analysis to determine whether the business is profitable, has enough money to pay its bills, could be paying its employees higher wages, whether the business is paying its share of taxes, whether the business is using its assets efficiently, or if the business has a gearing problem, that is, going too fast or going too slow, and changing from going too fast or going too slow. Whether the business is a candidate for being bought by another company, whether the business is a good candidate for investors to put their money in, and many more decisions. The important part here is once we've decided what we want to know, then we can decide which ratios we need to use to answer the questions or solve the problems facing us. If you will, I want you to think about financial ratios as vital signs for your business. Just like when you go to the doctor or you're in the hospital, the first thing they do is take your temperature, your blood pressure, your respiratory count, and your pulse. Financial ratios are the same way. With a little bit of information, we can determine a tremendous amount about your business. Now, I'm going to go through a lot of these ratios. In fact, I'm going to go through almost every one of them. We're going to talk about when and how they can be used and where the information comes from. Then I want you to, working with a counselor from the Small Business Development Center, I want you to develop a set of ratios for your business. I want you to identify which of those ratios are key ratios, that is, information that you should be looking at on a daily or weekly basis, which are not key but are important, and those you should be looking at on a monthly basis, and then a full set of financial ratios that you can look at annually with your small business counselor. Again, the intent of this presentation is not to get you where you can develop ratios and understand them and make decisions based on those. The intent is to identify some ratios, get you familiar with ratios that may be of value to your business, and then get you in a position where you understand enough about ratios to understand that they can help your business and they can help you be profitable. So the first set of ratios we want to take a look at are the short-term or liquidity ratios. These measure the ability of a firm to convert assets into cash. These ratios are supposed to gauge the ability of a firm to pay its bills as they come due. The primary concern of the firm's ability to pay bills over the short run without undue stress. So we want to look at our ability to pay our bills as they come due. Short-term solvency or liquidity ratios will help us. The daddy of all ratios, the current ratio, you'll see this one used more often than probably any other ratio. The mathematical formula is current assets divided by current liabilities. This ratio is the standard measure of any business's financial health. It will tell you whether your business is able to meet its current obligations by measuring if it has enough assets to cover its liabilities. The standard current ratio for a healthy business is 2 to 1, meaning it has twice as many assets as has liabilities, and simply put, for every dollar you owe in the short-term coming period, you have $2 with which to settle that obligation. When would you want to use the current ratio? The current ratio should be part of your business's basic financial planning, meaning it should be tracked monthly or quarterly. By keeping a close eye on this figure, you will recognize if it begins to get out of line. This will allow you to take early action to prevent your business from ending up in a difficult position. A current ratio of 1-to-1 means the company has $1 in current assets to cover each $1 in current liabilities. You should look for a current ratio above 1-to-1 and as close to 2-to-1 as possible. One problem with the current ratio is that it ignores timing of cash receipts and paid outs. If all the bills are due this week and the inventory is the only current asset, it won't be sold until the end of the month. So the current ratio tells very little about the company's ability to survive. The quick ratio takes care of this problem by pulling out current assets that are necessary to the continued operation of your business. So the current ratio tells you about your ability to pay obligations as they come due. The quick ratio, or the acid test, very much like the current ratio, current assets over current liabilities, but we're going to make an adjustment to current assets here and subtract out inventory. The idea is if you completely liquidate your inventory today, that is, sell it back to whoever you bought it from, and certainly would provide you with cash to meet your current obligations, but how are you going to open the store tomorrow? So assets that are essential to the continuing operation of the business are subtracted from current assets, and we just look at those that might be available for liquidation to pay liabilities or to pay bills. Like the current ratio, the quick ratio, also sometimes called the acid test ratio, measures a business's liquidity. However, many financial planners consider it a tougher measure than the current ratio because it excludes inventories when counting assets. It calculates a business's liquid assets in relation to its abilities. The higher the ratio is, the higher your business level of liquidity, which usually corresponds to financial health. The optimal quick ratio is 1-to-1 or higher. When you would want to use this ratio. This is an important planning tool, especially for businesses that can tie up a lot of assets in inventory. By tracking it monthly, you can keep an eye out for negative trends that could hamper your business's ability to meet its obligations. You can also use the quick ratio to evaluate the financial health of potential customers, since it also indicates whether a business can pay off its debts quickly. A firm with a low quick ratio may be more likely to delay payments because its assets are tied up elsewhere. Again, you can use these ratios from your customers to help you decide whether you should extend credit to them, and the quick ratio is a great one for that. Cash ratio. Cash divided by current liabilities. It measures the extent to which a firm can quickly liquidate assets and cover short-term liabilities. When to use this one, this ratio is of intense interest to a very short-term creditor. The higher, the better. And again, the cash ratio, cash divided by current liabilities, speaks directly to your ability to pay your bills as they come due. Net working capital to assets. Net working capital divided by total assets. Because the net working capital is so often viewed as the amount of short-term liquidity a firm has, the ratio of net working capital to total assets is a measure of liquidity. And it might be used in a relatively low value might indicate relatively low levels of liquidity. And that's your total net working capital. And we'll talk about net working capital a little bit later, but basically the formula for that is current assets minus current liabilities. So we've taken all of our current assets, all of our stuff we've got, minus everything we owe, divide that by total assets, and then that gives us an indication of the liquidity of the firm. This ratio is more valuable when compared to another firm's or compared to yourself years ago. That's more of a comparative type. How am I doing? Am I more liquid? Am I less liquid? You could look at that ratio. Interval measure. This is one of my absolute favorite for small business, especially if you're in the retail trades. Current assets divided by average daily operating costs. So we're taking all of our current assets, and dividing by our daily operating costs. Basically what it's going to tell us is the number of days a firm can finance operations without additional cash income. If nobody came in and bought anything from me today, or tomorrow, or the next day, or the next day, how many days like that could I make it? And this is, again, I said, an extremely important and an extremely powerful ratio for small business owners, especially in the retail trade. When to use this ratio? This ratio is useful when cash inflows begin to dry up as a result of a strike action or difficulty receiving goods from your vendors. So when cash inflows begin to dry up and management wants to know how long can the business be kept running with those very small or even non-existent revenues coming in. It also gives you a tremendous amount of freedom when you look at your interval measure, or not a tremendous amount of freedom, depending on how long that interval is. Once some small business owners take a look at this one, they get either really concerned or really happy. There's not a lot of middle ground on this. This is a ratio you should be tracking regularly, no matter what kind of business you're in. Now let's talk about some other types. Long-term solvency. We talked about short-term solvency ratios or liquidity ratios. Now we want to talk about long-term solvency or financial leverage ratios. These ratios measure the extent to which the firm has been financed by debt. They are intended to address the firm's long-run ability to meet its obligations, or more generally, its financial leverage. Failure of the firm to meet interest or sinking fund payments results in bankruptcy at the discretion of the lender, or could, rather than bankruptcy, could just simply mean that they foreclose and your business closes down. So what we're looking at here is the long-term solvency or the financial leverage. Basically what we're talking about here is how much of the business do you own and how much of the business does the bank own. And addressing that exact issue, in fact, is the total debt ratio. Total assets minus total equity, which will give you total debt. In the accounting formula, assets equal liabilities plus owner's equity. And by the way, if you haven't seen the video presentation on accounting by the numbers, a really good overview of accounting systems, and then the cash flow presentation, you may want to take a look at those, either after this presentation or prior to. So back to the total debt ratio, what it is. This ratio takes into account all debts of all maturities to all creditors. There are several definitions, including the ratio of the difference between total assets and total equity to total assets. Not sure that made a lot of sense to you, but it's total assets minus total equity divided by total assets. Again, that's the mathematical formula for it. When to use it, equity and debt are two key figures on a financial statement. And lenders or investors often use the relationship of these two figures to evaluate risk. The ratio of your business's equity to its long-term debt provides a window into how strong its finances are. Equity will include goods and property your business owns, plus any claims it has against other entities. Debts will include both current and long-term liabilities. The higher the ratio, the greater the risk to a present or future creditor. Look for a debt-to-equity ratio in the range of 1-to-1 or 4-to-1. Most lenders have credit guidelines and limits for debt-to-equity ratio. 2-to-1 is a commonly used limit for small business loans. Too much debt can put your business at risk, but too little debt may mean you're not realizing the full potential of your business and may actually hurt your overall profitability. When working with startups and new businesses, and we're looking at financing, we look at a total debt ratio or debt-to-equity ratio of about that 4-to-1 or so. Debt-to-equity ratio, total debt divided by total equity. This ratio indicates how much the company is leveraged in debt by comparing what is owned to what is owed. A high debt-to-equity ratio could indicate that the company may be over-leveraged and should look for ways to reduce debt. When to use this ratio, the higher this ratio, the more a company is relying on debt to finance its asset base. So if you're already sitting at a 4-to-1 debt-to-equity ratio and you go to the bank to borrow more money, they may be concerned that you're getting this debt-to-equity ratio too high. I will tell you, this is the key ratio that is observed by lenders when making their decisions on whether to issue additional debt or the initial round of financing to small businesses. And most banks have some guidelines on debt-to-equity ratios. So again, if you're looking to borrow money for your small business, this is a critical one for you. Equity multiplier, total assets divided by total equity. This is a leverage ratio that is computed as the ratio of assets to total equity. And the higher this ratio, the more the company is relying on debt to finance its asset base. Again, it's the whole idea of comparing who owns what. If you look at the formula for this particular ratio, the equity multiplier, total assets divided by total equity. Total assets, everything you've got, divided by the piece of it you financed. So again, the higher this ratio, the more debt you would have incurred, and the less likely it is that you'll be able to get additional debt. Total long-term debt ratio. With this particular ratio, we're looking strictly at long-term debt, not at total debt. Remember earlier on when we looked at the short-term liquidity or short-term current solvency ratios, we did a very similar ratio here, but it was just short-term debt, and that was the current ratio. This one looks strictly at long-term debt divided by long-term debt plus total equity. And what it is a firm's short-term debt changes constantly. In addition, accounts payable may be more a reflection of trade practices than debt management policy. For these reasons, the long-term debt ratio, which is a ratio of long-term debt to total capitalization, is frequently used by financial analysts. And this ratio is preferred to the total debt ratio if the focus of the firm, if the focus is on the firm's total capitalization. So if we just want to isolate capitalization, that is how the firm is basic method under which the firm is financed. That is, how is the firm financed in its most basic, essential construct, how the firm itself is pieced together with owner's money and debt. If what we're looking at is the long-term debt, the fundamental financing of the business, this is a great ratio to decide where you are. Times interest earned, this is a coverage ratio. We can do this with any expense. Any expense. In this case, we're looking at interest. It could have been, rather than times interest earned, it could have been times utility bill earned, times payroll earned, times any expense. Okay, this is a coverage ratio. So while we're just simply looking at times interest earned with this, we can do some simple substitutions and pull out interest expense from the formula and put in some other expense category and take a look at this. So if you've got one particular expense category which is very large relative to the other ones, you may want to start looking at a coverage ratio for that particular expense. If you're in the service industry, you're probably going to want it to be payroll. You can do a very similar analysis based on cost of goods sold. So for times interest earned, it's earnings before interest and taxes divided by interest. So we see that EBIT, that's earnings before interest and taxes. Now, if we were going to substitute the electric bill, for example, for this coverage ratio, it would be earnings before utilities and taxes. If we were going to substitute divided by utilities. If we were going to do this for payroll, it would be earnings before payroll costs and taxes divided by payroll costs. Okay, this ratio measures how well a company has its interest obligations covered with its earnings before interest and taxes. The lower the ratio, the higher the company's debt burden. As a general rule of thumb, investors should not own a stock that has an interest coverage ratio under 1.5%. Under 1.5. An interest coverage ratio below 1 indicates the business is having difficulties generating the cash necessary to pay its interest obligations. Fundamentally, think about this for a minute now. If the answer to this is 1, it means you cover your interest payments one time. That's pretty thin. If it's a number less than 1, you hadn't even been able to pay your interest. You may have paid your interest out of savings or from some other aspect of cash flows, but it doesn't appear on the profit and loss statement, on your income statement, that you can cover this particular expense. So you really want it to be 1.5 or more. I personally would like to see times interest earned at 2 or 3, where you earn 3 times what you pay out in interest. If we're talking about a critical expense like payroll, cost of goods sold, that number certainly you want it to be at 1. You want to pay it at least 1 time, okay? Because that's the one time you really pay it. So this coverage ratio is very, very valuable and can be modified. Again, work with your counselor at the Small Business Development Center to see how you can use that ratio in your business. Cash coverage ratio, every business ought to take a look at this. This is earnings before interest and taxes plus depreciation divided by interest. And this is earnings before depreciation, interest, and taxes. This is a ratio of EBDIT, which is earnings before depreciation, interest, and taxes, divided by interest. And this talks about your ability to have the cash available when it's time to pay the interest payment. What we've done there is pulled depreciation back out as an expense because depreciation is a non-cash expense. That is to say, no one shows up from the Bureau of Depreciation, knocks on your door and says, "Hi, I'm from the Bureau of Depreciation. I'd like my check." It is a non-cash expense. Okay, so it becomes an expense on your income statement. It becomes an expense on your tax return, but the cash never left. So when we look at the cash you have available to pay things like interest payments, payroll, and so forth, we need to add depreciation back in because that cash, again, is available for you to use in the day-to-day operations of your business, although it does show up as a negative, an expense on your income statement. Next, debt coverage ratio. This is the second most important ratio that a lender is going to look at. So, again, if you're in the process of obtaining financing for your business, you want to look at that debt to equity ratio. Now you want to look at the debt coverage ratio, which is net income plus non-cash expenses. We already talked about non-cash expenses such as depreciation. Okay? And there's some other, possibly, depending on the type of business you're in, other non-cash expenses. But depreciation is a general one that most people see. So we got net income plus those non-cash expenses divided by debt. And this indicates how well your cash flow covers debt and the capacity of the business to take on additional debt. It also shows how much of your cash profits are available to repay debt. Lenders look at this ratio to determine if there is adequate cash to make a loan payment. Because remember, when a lender's making you a loan, the thing they're most concerned about is not your collateral and is not necessarily even what you want to use the money to do. What they're most concerned about is your repayment ability. And this ratio pegs that as a number. It says your repayment ability is, boom, here, and it gives you a number. So how high does that need to be to convince your lender? I don't know, but I will tell you it needs to be bigger than 1. Because we need to know you can make that payment at least once every month. We would like to see it be a little higher than that. I've seen debt coverage ratios of 2.5% be considered 2 to 2.5 times be considered marginal by lenders. That is, you accumulate over the course of a month enough money to make 2 note payments, and they still are worried about your repayment ability. So with this one, the higher the better. Asset utilization or turnover ratios. These are activity ratios. This is another type of ratio. We've gone now from the short-term solvency, short-term liquidity, long-term solvency, long-term liquidity, ability to pay your bill ratios to activity ratios. This tells you how whether your assets are actually working for you or not. You know, no aspect of your business should be idle. If your inventory is not making any money for you, get different inventory. If your employees aren't making money for you, get different employees. If your location's not making money for you, get a different location. So this is a way you can take a look at some of those activities and see whether those things are actually making money for you. These ratios measure how efficiently or intensely a firm uses its assets to generate sales. These ratios answer the question, how has the business used its fixed and current assets? Other names include efficiency ratio, asset management ratios, and so forth. The first of these is the inventory turnover. Again, this one is critical if you're in the retail trades. Formula cost of goods sold divided by inventory. So if you don't maintain inventory and you don't have cost of goods sold, this is basically a worthless ratio for you, but we can modify it slightly to look at what your key expenses are and what the key components of your business are and look at those activities. This ratio tells how often a business's inventory turns over or sells completely out during the course of a year. That the idea is One inventory turn is the place is full, we sold everything, and we replenished all of our stock. That is one inventory turn. Now, I understand and you understand it doesn't happen like that. You can't stand at the front door and wait till the place is empty, mark down one inventory turn, replace all the inventory. You're continually replacing inventory, continually selling. So we looked at the number of times the inventory has turned itself over. Okay? Because inventories are the least liquid form of asset, a high inventory turnover ratio is generally positive. On the other hand, an unusually high ratio compared to the average for your industry could mean a business is losing sales because of inadequate stock on hand. Now, we'll tell you, when somebody comes to me and says, Mike, I think I'm positioned for growth. I think the reason my sales are lackluster or are not what they should be is because I don't have enough inventory. I can tell you right now, look at this number and answer yes or no. Okay? If your inventory turn is real high compared to the rest of your industry, then that probably is in fact the case, and you're not carrying enough inventory, and maybe you could and probably would increase sales significantly if you increased inventory. However, if your inventory turnover is moderate or low when compared to other people in your same industry, I would say no, I'm not entirely sure that additional inventory would be significant. Maybe different inventory would be, but not additional inventory. Remember, we're just looking at the dollar value here, and there's no judgment associated with whether that's the correct inventory to carry or not. If your business has significant assets tied up in inventory, tracking your turnover is critical to successful financial planning. If inventory is turning too slowly, it could indicate that it may be hampering your cash flow. Because this ratio judges annual inventory turns, it is usually conducted once a year. I personally like to take a look at this one quarterly to see whether you're on track. Day sales and inventory. 365 days worth of sales divided by your inventory. And this shows the average number of days it will take to sell your inventory. That's the number of days sales at cost in inventory. So we're going to take our sales for the year, divide that by the number of days we're open. In the example here, I've got 365. And then dividing that by the inventory will tell us the number of days sales we have in inventory. Now, in the formula where it says 365 days, that is your sales divided by the number of days you're open, and that will give you your one-day average sales. Look for trends that indicate a change, when to use this ratio, day sales and inventory. Look for trends that indicate a change in your inventory levels. Compare the calculated days in inventory to your inventory cycle. This one's most valuable when you're trying to decide whether you want to increase your inventory or decrease your inventory. If sales flow has increased dramatically, maybe you want to increase inventory, maybe you don't. If sales flow has decreased dramatically, then you probably do want to go ahead and reduce your inventory. So again, the number of days sales and inventory. Receivable turnover. This is the same thing as inventory turnover. This time, instead of taking a look at inventory and how quickly it's turning over, we're going to take a look at our receivables and how quickly they're turning over. Now, think just think for a second here. If our normal terms to our customers are 30 days. That is, from the time they receive the merchandise and the invoice, they have 30 days to pay us. Then our receivables should turn over every 30 days, okay? Which means it should be turning over about once a month or 12 times a year. So when we determine our receivable turnover, if it's higher than 12, then we've got a problem collecting our money. If it's lower than 12, then we don't have much problem collecting our money. Again, that's assuming that you give 30 days on accounts. If you give 15 days on accounts, then you're looking at 24 turns a year. Okay? And this is sales divided by accounts receivable. That's sales for the entire year, for the entire month, divided by receivables for the entire year or for the entire month. This number indicates how quickly customers are paying your business. The greater the number of times receivables turn over during the year, the shorter the time between the sales and cash collection. You want this number to be high. When to use it, receivable turnover is a good way to gauge the effectiveness of your company's payment terms. If this number is low compared to the industry average, it may mean your payment terms are too lenient, or that you are not doing a good enough job on collections. By tracking this figure monthly or quarterly, using total credit sales instead of net sales, you can uncover any changes in collection trends. And you need to uncover changes in collection trends very, very quickly. Very quickly. Days sales and receivables, just like days sales and inventory, days sales and receivable. Again, where you have 365 days, that's your average days sales. So the actual formula in that slot would need to be sales divided by number of days in the period. So if it's just for a month, sales for the month divided by the number of days you were open during that month, divided by your accounts receivable turnover, which we determined in the last ratio. Okay? Shows the average number of days it takes to collect your accounts receivable, number of days in sales receivable. This one is a much more refined, if you will, ratio than the one we just looked at previously, which was the receivable turnover here. This one is more on a monthly kind of basis. You're looking at a year's worth of data. This looks at a day's worth of data, so it gives you a much finer view of what's going on, and small nuances, small changes in collection patterns, small changes in credit patterns on your behalf, allowing additional credit to additional customers. This will give you a much, much finer view of that. Look for trends that indicate a change in your customers' payment abilities with this ratio. Compare the calculated ratio to your stated terms. Review an aging of receivables and be familiar with your customers' payment habits. And this ratio will also help you watch for any changes that may indicate a problem in your receivables. Accounts payable turnover, again, the same idea. In this case, it's cost of goods sold divided by accounts payable, but we're looking at how quickly the payables turn over. This is the number of times trade payables turn over during the year, and the higher the turnover, the shorter the time between the purchase and payment. A low turnover may indicate that there is a shortage of cash to pay your bills or some other reason for delaying payment, and a high turnover may mean that you're not taking advantage of all the credit terms you have, and that you could possibly do a little bit more leveraging and take full advantage of the credit terms that your vendors give you. Again, days in accounts payable, this is a bit more refined ratio looking at the same accounts payable account. This ratio shows the average length of time your trade payables are outstanding before they are paid. And this ratio will allow you to look for trends that indicate a change in your payment habits. Compare the calculated days in receivable to the terms offered by your suppliers. If you only have 4 days in accounts payable and most of your suppliers give you 15, you may want to stretch that out just a little bit. And then compare this to the industry standards. Review of an aging of payables and be familiar with terms offered by your suppliers so that you can take full advantage of the terms your suppliers do give you. Net working capital turnover, which is sales divided by net working capital. This ratio measures how much work we get out of our working capital. And working capital is simply current assets minus current liabilities. In other words, this ratio will tell us how much sales the business generates for each dollar of net working capital. And this is an extremely important ratio, especially if you're trying to decide whether you really want to increase your business, enlarge your business, reinvest money into your business. This allows you to look at your business as an investment rather than as a job, which is extremely, extremely important. When to use this, all things being equal, a high value associated with this ratio is good. And when you primarily want to use this is when you want to be able to compare segments of your business with each other to see who is most productive, or your business against other businesses to see whether your current assets are as productive as they should be. Fixed asset turnover measures how well the business generates sales on each dollar of fixed assets. And this is sales divided by net fixed assets. Again, it talks about how much work, how efficient, how effective your business is at using its fixed assets. A fixed asset turnover ratio of 2 indicates that for every dollar in fixed assets, the business generates $2 in sales. And that's a little bit overly optimistic. For most small businesses, this number will be a point something. And phrased a little differently, what that means is for every dollar you have in fixed assets, you generate 50 cents, $1, $2, $3 in sales. This is really helpful to be able to compare yourself to previous years. Total asset turnover, sales divided by total assets, not just fixed assets this time, but total assets, total assets. And this ratio indicates how efficiently your business generates sales on each dollar of assets. Personally, from a management standpoint, I find this to be one of the most helpful ratios. I recommend to a lot of small business owners, you look at this ratio every month, you track it, you compare it, and this is your basic scorecard. This is your temperature. Just like every time you go to the doctor. I'm going to the doctor just to get my prescription refilled. I'm going to be there a total of 15 minutes. He's going to look at me, poke around, take my blood pressure, run a couple of tests. Really don't even need to see the doctor. He's going to run a couple of tests, and he's going to say, okay, increase the medication, decrease the medication, or leave it the same. They still take my temperature. Why? Because it is such a critical indication of what's going on with the body. Total asset turnover, critical indication of what's going on with your business. Indicates how efficiently your business generates sales on each dollar of assets. Now, why do you have those assets? To generate sales. So this ratio answers a multitude of questions, and it's a great scorecard. A volume indicator that can be used to measure efficiency of your business from year to year, from month to month, from quarter to quarter. Now to the profitability ratios. These measure the management's overall effectiveness in maximizing the returns generated on sales and investments. These ratios answer the question, has the business made a good profit compared to its turnover? That is, how well are we doing with respect to profit? Gross profit margin, which is gross profit divided by sales. Gross profit is sales minus cost of goods sold. So before we can determine gross profit, we got to sales minus cost of goods sold. Most financial statements, most income statements will have the gross profit number already determined for you. The upper portion of the income statement, sales, adjustments to sales for returns and allowances, then maybe an adjustment to sales for sales tax, and then you'll have net sales right below that, cost of goods sold, and then gross profit. This is an indicator of how much profit you earned on your products without consideration of selling and administration costs. And there's some other things we can do with this gross profit margin. We can turn it into a contribution margin ratio, and we can use that in break-even analysis. This is an extremely powerful ratio, extremely powerful number. You really should be tracking your gross profit. This is what's left after you paid for the goods you sold. So you sell merchandise that cost you $2, and you sold that merchandise for $5, so your gross profit here would be $3, and your sales is $5, so you could come up pretty quickly with that 60-cent gross profit margin, which tells you on every dollar you sell, 60 cents goes to pay all the other bills that your company has except for your merchandise, which was already covered with cost of goods sold. Compared to other businesses, when to use this ratio, compare to other businesses in the same industry to see if your business is operating as profitably as it should be. Look at the trend from month to month. Is it staying the same? Is it improving, deteriorating? Is there enough gross profit in the business to cover your operating costs? Is there a positive gross margin on all your products? If we looked at this for the restaurant industry, it would be called food cost. So we have variants of this for almost every industry. If you're selling a product, this is a key ratio for you. Profit margin, and that is the return on your sales, and that's net income divided by sales. This ratio compares after-tax profit to sales. Basically, it shows how much profit comes from every dollar of sales. It can help you determine if you are making enough of a return on your sales effort. When to use this? If your company is experiencing a cash flow crunch, it could be because its markup is not enough to cover expenses. Return on sales can help point this out and allow you to adjust prices for an adequate profit. Also, be sure to look for trends in this figure. If it appears to be dropping over time, it could be a signal that you will soon be experiencing financial problems. We see this continually over and over and over. Profit margin begins to slip. Small business owners aren't tracking the profit margin. They don't know what's going on with their return on sales numbers, and suddenly they're not making any money. If you wait till the end of the year to determine your profit margin, then there's nothing you can do. The year's over. So this is one you need to be looking at again quarterly. Personally, I think monthly in some businesses. If you're headed into a busy season or a slow season, you may want to take a look at that ratio even more often. Return on assets. Net income divided by total assets. This number tells you how effective your business has been at putting its assets to work. The return on assets, or ROA, and you'll hear this one referred to by financial folks as ROA, is a test of capital utilization. How much profit before interest and income tax a business earns on the total capital used to make that profit. This ratio is most powerful when compared with the interest rate paid on the company's debt. For example, if return on assets is 15% and the interest rate paid on debt was 10%, the business's profit is 5 percentage points more than the interest that was paid, or you got room to make an additional profit. The other thing you can look at this is this return on your assets. As if you sold all your assets, took the money, and put your money in another investment, how much could you make off of that investment? 8%, 9%, 10%, 12%? If those assets are employed in your business, you can't accept less than a market rate of return for your assets. Otherwise, sell everything off, put the money in the market, take the 8% and get a day job. Okay? Return on equity. This is a return on your investment into the business. This determines the rate of return on your investment in the business as an owner or shareholder. This is one of the most important ratios, as it shows the hard fact about the business. Are you making enough of a profit to compensate you for the risk of being in business? When you would want to use this, compare the return on equity to other investment alternatives, such as savings accounts, stocks, or bonds. Compare your ratio to other businesses of the same or similar industry. If you don't determine return on equity for your business once per year, then you have absolutely no idea whether your investment into your business is really making you any money or not making you any money. In fact, it could be costing you money. Working with some small businesses not long ago, one of which looked at the past 5 years and looked at return on equity over the past 5 years. And for the past 5 years, this number has been negative. That means while he's still making a little bit of a profit and he's still taking money out of the business, what he's taken out of the business was money he invested in the business to begin with. In fact, if he continues in another 2 years, he won't have anything left in the business. He's already at almost a negative equity position. So the business itself is eating up his investment. He would be better to cut his he's marginally profitable. But that's because he's eating his seed corn. And he's marginally profitable only on paper, by the way. So, and that's a little bit of a different deal we'll talk about in another seminar. But return on equity, key ratio, you got to look at it. Sales growth. Current year's sales minus last year's sales divided by last year's sales. Look, we could do this for current week's sales minus last week's sales divided by last week's sales. Or we could make it current day's sales divided by minus yesterday's sales divided by yesterday's sales. Or this month's or current month's sales minus last month's sales divided by last month's sales. And this is a percentage increase, and it can be over any period of time. It can be the percentage increase for the year, percentage increase for the quarter, for the month, for the week, for the day. Okay, so percentage increase or decrease in sales between two time periods. Note, substitute sales for a month, quarter, or any shorter period of time. Look for steady increases in sales. If overall costs and inflation are on the rise, then you should watch for related increases in your sales. If not, then this is an indication that your prices are not keeping up with your costs. It's a wonderful place to track that. If you know the inflation rate's 1.3%, then at the very minimum, your sales growth should be 1.3%, just keeping up with inflation. Doesn't mean you sold anymore, you're just keeping up with inflation. Okay, cost of goods sold to sales. This is critical, again, for folks in the retail trade. We can do a very similar analysis with payroll for folks in service sector, computer repair, electricians, so forth. And again, that's cost of goods sold divided by sales. This ratio is a percentage of sales used to pay for expenses which vary directly with sales, and that is cost of goods sold. Look for a stable ratio as an indicator the company is controlling its gross margin. And again, we want this one to be fairly stable, not erratic. When this one starts jumping around, you've got huge problems. Okay? Selling general and administrative expense to sales. That's SG&A, selling general and administrative expense, divided by sales. And this ratio is a percentage of selling general and administrative cost to sales. Restaurant business, we do this same analysis and put in a particular individual expense. For example, utility costs should not exceed 7% of total sales. So we put, rather than selling general administrative expenses in there, we put just utility costs in there and divide by sales. And we're trying to keep that number at 7% or below. You can do this with almost any expense. Again, just like we talked about, turnover and activity ratios could be adjusted for any expense. This one can be adjusted for any expense as well. And it doesn't matter even if it's a relatively small expense. If it went from 0.5% to one month to 1.5% the next month, even though those are pretty small numbers, you still know you got a problem because it increased by 1%. Look for steady or decreasing percentages that indicate the company is controlling its overhead costs. Again, if you've got a lot of instability here, these things are fluctuating, it may point out that you have a problem with control or with management. All right, now let's look at some market value ratios. These ratios, these ratios are based in part on information not necessarily contained in financial statements. The market price per share of stock, and they can only be calculated directly from publicly traded companies. So these ratios are more for large companies or more for you to evaluate investments, those sorts of things. However, with some minor modification, and again, just contact one of the small business development centers anywhere in Mississippi. And at the beginning of this video presentation, and again at the end of the video presentation, we'll roll a slide that's got the 1-800 toll-free number. So if you didn't get this video presentation from a small business development center, let me encourage you to make that contact. And the ratios associated with the market value or investor ratios are critically important, again, for small business. And there are ways to get the numbers that we're looking for here, but it's rather complex and cumbersome, and your head's probably already swimming pretty bad from all the math associated with this. But be mindful that sitting down with a counselor from a small business development center, we can come up with these ratios just as well, such as earnings per share, which is pretty simple to determine, net income divided by number of shares outstanding. And if you're in the corporate format, or if you operate as a limited liability company, or if you are a partnership, we can determine earnings per share. It won't be shares of outstanding stock in the case of a partnership, but it will be earnings per share, or earnings for your share of the company. The portion of the firm's profit allocated to each outstanding share of common stock. It is a performance indicator that expresses the company's net income in relation to the number of ordinary shares issued. And when to use this ratio, it is important to investors because they can show how the company is doing over time. If the firm's earnings per share is consistently growing, the stock should perform well, or you should be able to find outside investors in the marketplace. Price-earnings ratio. This one is strictly for publicly traded stock because you will see that the numerator, price per share, is then divided by earnings per share. So in order to be able to determine a price per share, you have to get the market price. Now, with closely held companies, we can do some things that will allow us to estimate the value of the company, consequently estimate what a market price might be, but again, those are estimates. And it is helpful if you're trying to find investors to determine what your price-earnings ratio might be at various levels of selling, various levels depending on what the price for your stock is. We also use this ratio working kind of backwards into it by looking at price-earning ratios of similar companies, similar small companies, and then determining what your price-earnings ratio might be. We know your earnings, we know the PE ratio of other companies, and we can manipulate this formula a little bit and determine what a reasonable price per share for your company would be if you were getting ready to sell stock or searching for investors. So a price-earnings ratio or a PE ratio of 5 means the shares sell for 5 times earnings, or one could say that the shares have or carry a PE multiple of 5. It wasn't, and 5 is not a bad number. It wasn't long ago at the height of the stock market where we saw PE ratios of 25. Now let's think about that for a minute. A price-earnings ratio of 25 means, based on the current earnings level of that company, it will take the company 25 years to earn enough money to pay for your 1 share of stock. That's too high. 5, a little bit more reasonable. Some industries go as high as 7, some as high as 10, and it's going to vary industry by industry. When you would want to use this ratio, well, we've already talked about if you're trying to find investors in the marketplace, this is a good ratio, or some variant of this ratio would be good for you to determine what would be a reasonable market price. Because the price-earnings ratio measures how much investors are willing to pay per dollar of current earnings, higher PE ratios are often taken to mean the firm has significant prospects for future growth. And that is, if people are willing to pay 25 times earnings for the right to receive that it's because they think those earnings are really going to accelerate in the future and drive that PE ratio down. If a firm has no or almost no earnings, its PE ratio will probably be quite large. Therefore, care is needed when interpreting this ratio. Market to book ratio, that's the market value per share divided by the book value per share. And of course, book value per share is total equity divided by the number of outstanding shares. Since book value per share is an accounting number, it reflects historic cost. Therefore, the market to book ratio compares the market value of the firm's investment to their cost. A value less than 1 could mean that the firm has not been successful overall in creating value for its shareholders. And we can do a variant of this even if you're not in the corporate form. We can look at market value to book value for specific assets or for the entire company for small businesses. It's a little difficult to determine in some cases the market value, but this is a really good ratio to look at to see whether over time your business has in fact generated value. All right, now dividends per share. Dividends paid divided by the number of shares outstanding. And this is the portion of the company's profits per share paid to shareholders. When you would want to use this, firms make a choice whether to pay high dividends to shareholders or to reinvest profits for future growth. Usually high growth stocks do not pay large dividends if they pay any at all. The expectation is that the shareholder will make profit by selling the stock at a higher price at some point in the future. Dividend-paying stocks can also increase in value, but the increase is sometimes less important to the shareholder than a consistent growing dividend. And then dividend yield, finally. The dividends per share divided by the current share price. And again, we can take a look at this as a return to investors. This is the return on a stock as a result of dividends paid. Income investors value stocks with a high dividend yield. This is a reasonable strategy. However, you should be careful. Sometimes a stock has a high dividend yield because the stock price has decreased sharply. So this may not give you the indication that you want. Now, that completes the slides and completes the formal part of the presentation. A couple of things as we close out. First and foremost, we've got some tools at the Small Business Development Center. If you can bring us 2 profit and loss statements, whether that's 2 months or 2 years, we would prefer it to be 2 years, so we could look at a little longer time period of data. But if you can bring us 2 profit and loss statements, 2 income statements, or 2 tax returns, and at least 1 balance sheet, then we can put the information in the model and start looking at ratios. We can then compare those to the industry averages and tell you you're more profitable, less profitable, or about as profitable as other people in your business. Your cost of goods sold is higher, lower, or about the same as other people in your business. It's always good to compare yourself to other people, and then because we've got 2 years worth of data, we compare or 2 months worth of data or 2 weeks worth of data. We can compare the current period with the previous period. So where financial ratios are the most powerful is when you can compare them. A current ratio of 2 doesn't tell us an awful lot. Well, it tells us something, but it doesn't tell us as much as it was 2.5, but now it's down to 2. Now that tells us we've got a problem, because it dropped to a much lower ratio. Not a big problem necessarily, but it does tell us that we may well have a problem. Again, the power of financial ratios is in the ability to compare those. You can compare yourself to your business to General Motors if you would like, using ratios, because we distill everything down to just those key numbers. So first and foremost, it's extremely powerful in comparing yourself with others and comparing yourself with yourself. Number 2, it's extremely powerful in day-to-day managing of your operation because it gives you a standard. Just mark this down someplace. Where there is no standard, there is no control. Where there is no standard, there is no control. I'm driving down the highway at some rate of speed, and suddenly I get pulled over by Mississippi Highway Patrol. And he comes up to my window and he says, "Boy, you are just completely out of control. Where do you think you're going?" Now, how does he know I was out of control? Speed limit 70 miles an hour, and I was driving 130. Okay, we know I was out of control because the standard's 70, and I was way off past that. I was almost twice it. Not that I would go 130. But my point is, how do you know you're out of control? Because you got a standard against which to compare. Financial ratios will give you that standard with which to compare. Are my accounts receivables out of control? I don't know. Let's take a look at the receivable turnover and see. So it gives you a standard by which you can judge. So first and foremost, it allows you to compare yourself to yourself, yourself to your competitors, yourself to other people in your business. Number 2, it gives you standards by which you can much more effectively and efficiently manage your business. How do we know we're out of control? You deviate too much from the standard. And these ratios can, for a lot of businesses, and in most all cases, become those financial standards. And then number 3, it helps you evaluate whether your business is just a job or is it an investment that makes you money simply because you're the owner. And you want to move yourself to a position where you're making money because of your investment, because of the risk you assumed, rather than making money because you got a job. My experience is in most small businesses, you could probably make more money as a practitioner, technician, an expert working for somebody else than you can working for yourself when you look at the number of hours you have to put in working for yourself as opposed to working for someone else. So it does allow you to evaluate your business and evaluate the productivity and the efficiency of your business. I hope you got something out of this presentation. I'm sure you did. Financial ratios are extremely powerful. Extremely powerful. Just as financial statements will give you the financial position of your business, key ratios will distill that information down into a couple of 3 or 4, and quite frankly, most businesses only really need to track a half a dozen of these at the most. 3 or 4 that you're tracking on a regular basis, and a couple more that you look at quarterly, and maybe 1 or 2 more that you look at annually, and that should be enough, because remember, these are thumbnail snapshots of what the business looks like. So instead of trying to review 2 pages of an income statement, 2 pages of a balance sheet, and looking for all the differences and trying to make yourself an expert in accounting, all we really need to do is get you and your financials in. Let's run them through the model one time, find out what your financial ratios look like, and then analyze those, and we'll be able to give you some information on the health or lack thereof of your business, and then start tracking those. So now you really don't have to know a ton of accounting. All you have to know is my current ratio was 2 last time, and it's 2.5 this time, and bigger's better. I like that. Yeah, let's keep going in that direction. Or my inventory turnover was 4, it's now 3. Do I have too much inventory, or do I not have the right inventory, or am I not selling the right stuff? And these ratios will help us analyze and determine that information. And with just a little bit of help, a handful of key ratios for you to track from month to month, you'll be shocked. You'll be absolutely surprised at how much control you have over your business, how much easier it is for you to manage the day-to-day affairs of your business and not get bogged down into a million things. You know, running a small business, you find yourself sometimes in that unenviable position where you can't see the forest for the trees. And financial ratio allows us to clear out all the trees, get rid of all of the other stuff, and focus in on one particular aspect of our business. And I mean really focus in on it. And if we do that on the key points of our business, not every point of the business, but the key points. And again, we're only talking about a half a dozen or so. But if we do that on the key points, it will become, for your business, the equivalent of the doctor taking the vital signs. It will allow you on a weekly, monthly basis to take the vital signs of your business. If there's anything that we at the Small Business Development Centers here in Mississippi can do to assist you, I hope you'll give us a call. And again, thank you for viewing this presentation.